Vicky's keynote message has set the scene as we move into the remaining two panels for this year's forum. A reminder that an updated schedule as well as all the panelists' bios can be found in the event app. Second, we encourage you to submit your questions via Slido. Our first panel today is Achieving Consensus on Climate Risk and Resilience, Insurance Sector's Role, moderated by Andrew Mais, NAIC Vice President and Commissioner of the Connecticut Insurance Department, also known as the poacher of other departments' talent. Andy will be joined by Amy Bach, the Executive Director from United Policyholders, Rakhi Kumar, Senior Vice President for Sustainability Solutions from Liberty Mutual, Anna Sweeney, the Executive Director, Prudential Regulation Authority, UK, and the Chair of the Sustainable Insurance Forum. And thank you to Anna. We, in Massachusetts, recently became a member of the Sustainable Insurance Forum, so thank you for that. And my friend Craig Swan, the Chief Executive Officer from the Bermuda Monetary Authority. So with that, Andy?
Good morning, everyone. Thank you for joining us today. I know it's been difficult. You've had to look at Gary's tie, and God knows where he bought that. Dr. Saporta, and I think Vicky's still here, in her statements spoke about the global consensus that we as regulators need to move forward on addressing climate change. That is a concern of supervisors, it's a concern of industry, and it's a concern of government. We've got a great panel here today to discuss this, and not just the way that we move forward, but also what may be the obstacles in our way. Now, I just want to take a minute to talk about what we've been doing here at the NAIC for those who may not necessarily have caught up in all that we have accomplished. We've got a climate and resiliency task force, and that's had several charges. It's got to address climate-related risk to financial solvency, market considerations regarding affordability and availability of coverage, because I think if you look and you see what's going on in terms of extreme weather events and in terms of the protection gap, that's a concern that we as regulators share. And consumer outreach, as was mentioned earlier. So we have to promote mitigation, we have to promote education, we have to make sure consumers are aware of what's available to them. Now, I think as Gary mentioned, or somebody mentioned, may have been Vicky earlier this year, the NAIC adopted a revised climate risk disclosure survey, which is essentially aligned with a TCFD. And that is good for a number of reasons. One, it reduces regulatory redundancy. And secondly, it gives us a template so we can compare across insurers. We've also recently adopted a proposal to create a CAT modeling center of excellence at the CIPR. This is a proactive step to help state insurance departments coordinate and collaborate around the use of catastrophe models. And being able to use the models, being able to have the information on what insurers are doing is important. And I will tell you, Connecticut was one of the earliest states. We've had a number of states that have joined on. And at this point, we've got pretty much, I think it's about 80% of the premium in this country represented in our climate risk disclosure. Not 100%, but it certainly is a representative sample, and it certainly tells us where the concerns are and how companies are choosing to address them. Now and sorry to the panel, I gotta talk all about what the NAIC is doing for a minute. But the solvency work stream of the task force has developed recommendations to update state financial solvency tools, including the risk-based capital framework, to consider adding wildfire, which, as we all know, has become just way more common in certain areas of the country, and severe convective storms. We're also looking at the Financial Condition Examiner's Handbook and the ORSA. Now, my department released guidance in April for this, and the goal is to help insurers identify their climate-related risks and the opportunities to take a proactive approach to managing it, while balancing with the need to continue offering policies and products that benefit consumers. Insurance is the first line of defense for recovery. But if we build in mitigation and resilience, that also makes it the first line of defense for prevention of the damage. And we all know how much cheaper it is, how much more cost-effective, and how much more efficient it is to prevent damage as opposed to have to address it after an event. Now, our panelists are going to discuss the sector's role in boosting resilience to climate risk and how collective efforts can counteract the implications of severe weather and natural disasters. Now, I think we had it on the screen. You've seen the panelists. You know, they've got it's a varied background. There's industry, banking, not banking, but the Prudential Regulatory Authority, the Bermuda Monetary Authority, and one of my favorite consumer representatives, Amy Bach. You know, their info the bios are all on the website if you want to take a look at that. And of course, as Gary mentioned, make sure that you have slido.com available so you can ask questions. So let's start off with the questions, and I'm going to start with the protection gap. You're at the end, so you got to go first.
Okay, I'll go first.
There's still substantial gaps in regards to coverage for NatCats. In which areas do you have the biggest concern that the coverage is insufficient? And what strategies can we all use to reduce that coverage gap?
Yeah, thank you so much, and good morning, and thank you to the NAIC for the invitation to speak here today. So I think one of the biggest concerns we have is around trying to apply the tools and methodologies and climate thinking that was largely developed for the banking and investment sector and retrofitting or trying to apply it to insurance without adapting it to our business models. And the reason I say that is the businesses are different. When it comes to investments, they're trying to maximize return by minimizing risk. We're in the business of taking on that risk. And it's really about risk management, not necessarily constantly mitigating that risk. And what that means is that if we are to, how do banks and investments actually manage or mitigate the risk? It's through the portfolio. That reduces systemic risks for their sectors. For our sector, and by reducing it in our portfolio, it does not reduce climate systemic risk. That risk still exists, but who's left holding it now? It's the governments, taxpayers, and communities and individuals. And so in our thinking, that it's really resiliency, as you mentioned, is key in order to keep insurance affordable and accessible. And that's what it's going to take in order for us to be a viable industry.
Thank you, Rakhi. Let's turn to Amy for a consumer perspective on this.
Thank you. So the protection gaps that I see, that my organization sees when we go into an area with our Roadmap to Recovery program where there's been a wildfire or a hurricane, are very much in the some of the changes that the insurers have made to the policy forms and to deductibles, which result in there not being as much cash appearing to be available to the impacted property owner to make the repairs and to feel secure that, as you know, as we all know, insurance is the #1 aid to disaster recovery. There's nothing comparable. FEMA's great, but if you have insurance, you know you have a great shot getting back on your feet, restoring your assets. But when somebody is facing a high deductible, or they're facing a limitation on coverage for water damage, or they don't have building code upgrade coverage, it creates a sense of panic with the impacted property owner in the beginning. And so while I understand why insurers have made these changes, I do, I think that it's the protection gaps have grown to the point where, for example, Fannie Mae is concerned about the integrity of the coverage providing the same function that it has traditionally provided. And that I'd say is the protection gap we see.
Before I'm going to turn to you next, Anna, but just one follow-up on that. One of the concerns that I have, certainly, as I look at coverage, is that we've had a tremendous increase in the cost of replacing, in materials, raw materials, all that, so the damage that creates. Do you have a concern with consumers not being properly covered, that consumers may have decided to either keep their current coverage, to not have their coverage reviewed, and thus we end up with a situation where the coverage that once might have been adequate will not be there, will not be enough after a disaster?
There's no question that we are seeing larger numbers of people who don't have insurance. That's a little, can be mystifying, because of course if you have a federally backed mortgage, you're supposed to have it. But we are definitely seeing more and more uninsured losses. We saw that in Paradise. I think Commissioner Toll is seeing it in New Mexico. So there is that. And yeah, I mean, people are definitely, as I think people know, a lot of Americans are living paycheck to paycheck. So if it's a question of putting food on the table or paying for insurance, if it's optional, there's more of that. And of course, in a lot of these most vulnerable areas, the cost of property insurance has gone up quite a bit. Again, understandable, but sort of a vicious cycle.
Thank you. Anna, you're from the UK, you're Executive Director of the Prudential Regulation Authority, but you also have another job title, as you have a Sustainable Insurance Forum, which is where everybody gets together to try and figure, all the stakeholders, to try and figure out how to address this. What would you add to what we've heard?
Thanks very much, Andrew, and thanks for the opportunity to speak today. I think I would point to the fact that the coverage gap is it's not just one simple thing. So there's obviously the affordability issues that Amy talked about, but there's also other forms of coverage gap. One where there may be an assumption that the government or other authorities will step in. So the coverage is effectively unused, so it exists in the market, but it's unused by consumers. And I think we heard Petra yesterday talk about some data that she'd seen in various European countries where that was actually a major factor in the flooding in Europe last year. It's also a common feature in earthquake coverage in Italy, for example. And I think there's another source of coverage gaps, which is actually where there can be confusion around what the coverage is available. We've seen that, a classic example of that in the pandemic around coverage on business interruption, for example. So I think as well as the really good points around the sort of classic coverage, I think it is worth thinking about those other areas where coverage can either be unclear or not appealing to customers, and thinking about how to address all of those different types of coverage gaps, I think, is important.
Thank you. Craig, you're the CEO of the Bermuda Monetary Authority. You've got an island nation that in many ways is susceptible to the effects of climate change, and more immediately susceptible than a larger continent like this. So it's vital, I would think, for your constituency to have the coverage they need and to provide resilience. What do you think? Do you see coverage gaps? How do you address those coverage gaps?
I wouldn't say that it's that pronounced in Bermuda itself. We seem to recover quite well from these issues, and there's mandatory coverage for certain things. But from a wholesale market perspective, more globally, according to the Swiss Re Institute, for 2021, economic losses from natural catastrophes was approximately 270 billion. And of that, only 111 billion was covered, leaving a protection gap in terms of economic cost or losses of some 59%. And of those losses that were insured, over 70% came from secondary perils, and some of them were mentioned here. So that would be like floods and wildfires, droughts, and tornadoes or convective storms. What that publication went on to state was that of that 270 billion, some 80 billion came from floods alone. And of that 80 billion, only 20 billion was insured. So that was a protection gap of 75%. And so certainly there are concerns in a number of areas, but definitely floods would be one area that's particularly concerning across the globe itself. One key finding from that report was that for a single event, floods have become so severe that they can be as costly to an insurer or even more than that of a primary peril, such as a hurricane. But briefly get into a strategy. We definitely need a strategy that is a holistic one, that is proactive. And so I think, as was mentioned before, we need to plan before the catastrophes come. Certainly public-private partnership, but regulatory support is needed as well. But what insurers can do is they can use their modeling capabilities to help design or help identify and develop disaster scenarios, which then will identify various vulnerabilities as well as early response mechanisms. Okay. And then with that, and I heard it mentioned early on, with that, when you have those two elements, then you can talk about designing or taking resilience measures. Then you can talk about educating consumers about the vulnerabilities and risk mitigation. Okay. Then you can put in place social protection programs. And it's going to require definitely some, I would say, innovative solutions, particularly around parametric triggers, because they can pay off much quicker. And how supervisors can support is to continue to build our capabilities in terms of understanding climate change solutions, risk change solutions, so that we can provide the appropriate authorizations. And I would end by saying that where such solutions are novel and untested, then it may assist to have either a regulatory sandbox or innovation hub.
Let me just put you on the spot for a second here. So you mentioned in Bermuda there are required coverages. What do you think the role is? Does this work? What's the role of the government? Because we've heard, as Amy just mentioned, there are people who simply don't have insurance. And if something happens, either the federal government has to step in or they have a tremendous loss. Do you think that having government or regulators prescribe coverage for consumers is effective?
Generally speaking, I would say yes, from the government's perspective. But also, there are other elements that I heard, inferences. It's important for the, again, a holistic approach. So essentially there needs to be cooperation between industry. So they need to design products that governments can actually afford and that works with. I think in the U.S. you have certain protections where, you know, are around terrorists and floods. So with a partnership, I think it is important because if someone's going to pay the cost. So if it's not through insurance or solutions like that, then it's going to come through social assistance, and so government's going to pay the cost in any case. So it's best to plan the approach as opposed to, as I said, run after.
Now, just a reminder to the audience, Slido, you can submit your questions. We see some questions on here already, and I'm going to get to those soon. But first, let me just turn to Anna. It's your turn now again. You've got that perspective, that transnational perspective. You can see what different supervisors, what different members of industry are doing. What do you think has enough of a consensus developed about mitigation, pre-disaster mitigation? And what do you think we as regulators, as supervisors, could be doing? What could we be doing better?
I think the heart of regulation is around risk management and encouraging firms to manage their risks, to understand it, to be able to measure it, and to be able to mitigate it. So I think that mitigation is completely central to the way that we need to address this risk, and that firms need to address it, but also encourage consumers to prioritize and to understand the benefits of mitigation. I think the role of regulators, there's obviously lots of different participants in this. There's government, there's industry, consumers, regulators. I think the role that regulators can most usefully bring is actually thinking about how to bring that feedback loop into clarity. So each individual consumer and each individual firm is taking their own decisions. What the regulators can do is measure and sort of report back and help transparency around what the cumulative impact of those different steps is. And I think one of the most useful ways that we have seen increasingly over the international community is the use of stress testing to think about what the sort of current gaps are, but what the prospective gaps are under different pathways, and essentially provide that cumulative systemic wide view of where the sort of costs are, where they'll come, where the gaps are, and how that links to the actions that governments or other authorities are taking, and see whether there is a sort of disconnect essentially between the sort of top-down view from governments and the reality, and whether we're going to see some steps that there's a sort of smooth pathway to addressing the climate risks, or whether the transition isn't going to be smooth, and we end up with areas of society that are not sufficiently covered, and the government policies are not having an effective impact on the decisions that the different participants are playing. So that feedback loop for me is the critical role that regulators can play.
Thank you. We're going to stay on resilience, and I'm looking at you, Rakhi, so get ready. We've heard, parametric products. We've heard that industry has to innovate to provide new products to help close the coverage gap. But let's take a look before that, going back to the idea of mitigation and resilience. What do you think the role of industry should be? How is that evolving and providing, let's, for instance, investments in infrastructure that would help much of our population better better tolerate climate risk, let's put it that way.
Yeah, and I really want to pick up on what Craig said here, which is, it has to be public-private partnership, but even before product, you have to go into thinking. So one of the things we really need to do is push for systemic thinking of greening of our models, of our data, et cetera. What do I mean by that? One of the things we say at Liberty is, if you want to save a family, you have them build a house on a higher above sea level. You want to save a community, you have a seawall. If you want to save the planet, you grow a mangrove that acts as a barrier. Now, so that's right. But do your models give you credit for the mangrove versus the seawall? So that's what I mean by greening of and the thinking, and that thinking has to get started because, and it means almost rethinking the way we've got our tools and models going. And there's a lot of data problems we've talked about, and I know we'll hit on data later, but there is, one of our research has shown that for us to manage risk and to even manage the risk, data is available for perils that are insured, like insured versus non-insured, and then two, for geographies where insurance uptake is high. But we know climate change is impacting communities where insurance uptake is not high. And in those areas, there's not enough being invested and not enough information to even manage that risk. So that's a real problem.
Amy, let me go back to what you'd said earlier about education. Certainly, I will tell you from my side as a regulator, we try to get as much information out as possible. Are we doing it right? What is the best way to educate consumers, and how do we manage whether or not that is effective, whether it's on the mitigation or the coverage side?
Well, I've seen a tremendous amount of good work happening at the NAIC and from individual departments in speaking with one voice about what are the things that a property owner can do to mitigate and reduce risk. And I think, there has been dialogue over the years, to encourage insurers to try to not advertise, the cheap, 15 minutes, basically encouraging people to continue to shop on price alone. That it's really important that you spend enough time, understanding what you need to buy to protect what for most people is their biggest asset, right? So I think, though, that you can talk all you want. Insurance is never going to really grab the average person's attention. Let's be real. But incentives and rewards do. So where we're seeing tremendous progress, and in the western states where wildfires have become, wildfires associated with drought and climate change are an increasing challenge for property owners, for regulators, for insurers. There's just a sort of a fast forward going on of trying to identify what measures are effective in reducing risk, getting consensus around that, having it be incorporated into insurers' decision making, and then giving property owners very concrete and simple carrots, incentives. Say, if you do this, if you invest time and money in doing this, this is what you should do, A, B, C, D, these are the steps, and then this is the reward you're going to get. So I think, obviously we have a long way to go, but if you want to look for things to be hopeful about, I think in America, one of them is this recognition that we're not powerless in the face of climate change. There are things that we can do. We just need to help people understand what they are.
Let me just follow up on that because, we've been discussing the idea of public-private partnerships. We're all in this together. You discussed incentives for consumers. What kind of policy directives would help that happen, would help consumers, become incentivized to invest in resilience, for instance? What could we as supervisors be doing?
Well, there really are two things. There's making sure that people will get recognized for their investment of time and effort in risk reduction, either through being able to keep their insurance, so a renewal guarantee of some kind, renewal assurance. I know the word guarantee is scary to a lot of people, but a renewal assurance. And then the second reward is a price break. So, we just hear this over and over. Well, I replaced my roof and I created defensible space, but my insurer still dropped me and I still got, when I had to, replace the coverage, it was twice as expensive. So why bother if I'm not going to get a break for it? And of course, insurers have a very legitimate point that, well, until we have the data that assures us. So I would say regulations like what are in play in a lot of states already, that a rate filing must recognize the steps that that a property owner has made in some way is a very, very important work stream that's underway, I know. And then, continuing to dialogue with insurers to sort of, bring them under the risk mitigation tent, which of course they are, but I mean to try to really get, this bridge the divide with insurers feeling like, well, don't force us to take risks that we shouldn't take, or don't force us to stay on a risk while the consumer has this reasonable expectation. Well, I've been paying for all these years and nothing has changed, but suddenly I'm no longer appealing. That doesn't seem fair.
Thank you. Now, Craig, let me ask you. Bermuda is in many ways a lab for risk transfer. You tend to be on the cutting edge and so much. As we look around, as we move forward in terms of the increasing sophistication of models, what role is that playing in risk transfer right now? And do you see, from your vantage point, new, the innovative products that you'd early mentioned? What kind of innovative products do you see coming? Products that may not necessarily have been possible a few years ago.
Yeah, thank you very much. A successful investor would tell us that we shouldn't invest in companies that we don't understand. And the same applies for insurance underwriting. Successful insurers don't accept risks that they don't understand. Or if they do, then they ensure that they only apply or accept very immaterial limits to learn about that risk. And so as models are becoming, modeling capability is being developed and more sophisticated, then it's enhancing the understanding of the risk, which allows for then better pricing. And then we can expect from a risk transfer perspective that the companies will be more willing to accept, apply greater capacity and cover a wider range of perils. And some of the areas that we're seeing development in would be, for example, some vendor models are beginning to incorporate climate change add-ons, which is giving a longer range, longer time horizon view of risk. But also a number of insurers have proprietary models which allow them to have their own view of the risk itself. So certainly we would expect, all things being equal, for there to be greater capacity that's applied or allocated for a wider range of perils. In terms of Bermuda and what we've seen, we've considered a number of innovative solutions for which we've licensed, many in our limited purpose classes and our innovation class. To name a few, we've seen indexed and weather-based insurance pools with parametric covers. We've seen business models that continue to monitor. And what they do is have hourly payouts based upon energy price as well as weather, temperature thresholds. And we've also seen business models that use machine learning, analyzing terabytes of data from a variety of sources in order to make underwriting decisions on perils such as wildfires and the likes. So the way we view ourselves being in a wholesale position is that a key role for us to play is to be a facilitator of solutions to global challenges.
Thank you. Speaking of global challenges, let me turn to you. The UK has done an awful lot. There have been a number of announcements coming out of the UK on climate change and disclosure. Right now, recently, one of the things that you did is you're mandating climate risk disclosure. Can you expand on that just a little bit more for me? Tell me what you're doing, what you may be planning to do, what the goal is there.
Yeah, thanks. So we've tried over the last sort of 2 or 3 years to take a number of different angles to requirements on the insurers. I guess in the first instance, we've set out a series of expectations about sort of management, governance, and risk management that we have required the firms to implement, so that this is not an exercise on the side. This is actually climate change risk management is actually at the heart of how they run their business, measure risks, and take decisions about capital allocation, about pricing, about investments, and that's something where I have to say we, regulators are used to putting out messages about where industry needs to do more, and I definitely would say that industry still needs to do more, but I think it's probably worth us recognizing how much industry has come forward, just even over the last 2 or 3 years. I think we've seen, certainly in the UK, we've seen a real step change in how the firms are thinking about it. The second area is stress testing, and as I said, we've seen that across a range of different countries, and I think one of the benefits of sort of international organizations, events such as this, is being able to share examples, and I think stress testing is one of those where a little bit of both sharing of best practice, but also a little bit of competition between jurisdictions, and thinking about, actually, well, if they did that, how could we make that slightly better, I think is another step forward. And we in the UK will be publishing the results of our stress test, which runs across both banks and insurers, later this month, and look forward to sharing that in future discussions. And the third main area is on disclosure, and I think just want to take the opportunity to congratulate the NAIC on the recent introduction here. I think disclosure sort of has to be really at the heart of everything. Without adequate information, all of us are acting blindly, whether that's the firms themselves, whether that's investors, whether that's governments. So having data that is comparable, proportionate, and forward-looking, I think, is at the heart of how we're going to address that. I would say, though, and I completely recognise the data challenges, and I'm sure Rakhi will talk about it more from a practical perspective. But I think it's really important that we are proportionate about this. Every new risk that we've ever faced, that the industry's ever faced, we've started out with concerns around data and how do we get the right data. And it's right that we push on it, but it's also really important that we don't let the best be the enemy of the good here, that we do actually have a crack at using the data that we have. So in the UK, we're looking to mandate that kind of just pillar 3 disclosure, and the government's also looking to put in place requirements for firms to set out their own path to net zero, and it's important that that is not just a sort of marketing exercise and a greenwashing exercise, but there's actually some substance behind that, and having that core bedrock of comparable data is the key to that.
As you suggested, we'll switch to Rakhi. Now, Rakhi, you chair Liberty's Climate Council, and you're responsible for the TCFD disclosure. Let me ask you first, what was that like? What were the challenges in putting that information together and making it understandable? And I do know that Liberty has let me just call it a unique approach to stress testing and climate change. Can you tell us a little bit more about that?
Sure, how much time do I have for this? I'm just kidding.
3 minutes. But.
Yeah. Well, it took us over 3,000 hours to get this done, but let me summarize it in 3 minutes. So we did 3 different exercises. The first one, of course, we're a global insurer, so thank you, Anna. We did take part in the PRA exercise. The second one was stress testing our investment portfolio, or conducting scenario analysis or investment portfolio. And the third one was doing a system-level assessment of these models to understand what are these models doing and why. And I'm going to focus on the last 2, which were a choice that we have for us. And why did we do these 2 different exercises and how did they interact with each other? And I said, you really want to focus on how you manage your business. And one of the common approaches or what is being asked of companies is to stress test or conduct scenario analysis over a 5, 10, 15, 20 to up to 50 plus years. Well, we liken that to asking someone in 1970 to use models to predict what the world would look like in 2000 and 2020 and then make business decisions. I don't know if there would be any model that would predict the pandemic in 2020, but let's just say, so one of the things we wanted to do was saying, okay, 5, 10, 15 years, what we call the short to medium term horizon, models are better, data is better, a bit more reliable and more useful from a business perspective. So that's what we did for our investment book of business. And I'll come back to vendors on that one. And then the second part, which we said we need a qualitative assessment of horizon scanning for the longer term. So that's what we did was unpack what we call the NGFS, or the Network for Greening of the Financial System. There's an open source model out there which has been developed by central bankers, et cetera. So we unpacked those and got some very interesting macro insights that I'm happy to share later. As I mentioned, this exercise was all-consuming and over 3,000 man-hours, so for one person, close to almost 2 years' worth of work. Coming back again to something that Amy said, we want it to be comparable. Well, one of the things we also realized through this exercise is your results are going to vary based on the model you choose and the vendor you choose. So that's an example of where we are really with regards to I'm not saying we shouldn't do it, but it's the utility and use case. And what are you going to do with that information? And I think you've been very careful in saying it's a first step and let's really understand. So we really appreciate that, and that's very good. But I think there's a reality check of what we want to do, how fast we want to go, and where science is, and what we can actually do.
Did you want to say something, Greg? No. Okay. You looked at me, so I thought you might. But since you're here, let me ask you this. Insurance-linked securities, what role are they playing? Bermuda's a center of that in helping to manage climate risk.
Yes. Just stepping back just a little. There's a saying that you shouldn't put all of your eggs in one basket. And over the years, different people have placed spins on that. And so I think Andrew Carnegie basically said that you can put all your eggs in one basket, but you should watch your basket. And then I think Elon Musk came and basically said, if you put all your eggs in one basket, then it's okay to do that as long as you control the basket. And so just as a backdrop to the question that you asked, I think for a fitting expression or spin for a reinsurer is basically whatever basket you put your eggs in, make sure you fireproof them, waterproof them, and then work with the chickens to ensure that the coop is as secure as possible. And so what we're kind of seeing across the market with reinsurers is that they are putting more cat risk eggs in their baskets, but then they are working to mitigate that particular risk. And to me, that's where the ILS is coming in with the retrocessional coverage. And so while we see more risk, we also see more reinsurance to the retrocessional markets. And that seems to be where the ILS market is coming in to provide that mitigation and allow for greater coverage.
Let me go to our top question on Slido. And Anna, I'm coming to you with that one. Says, we understand climate risk, but now see that an energy shortage drives hyperinflation and food shortages. Will climate risk balance a long-term energy shortage? And I think we could make the question larger as we move forward. We've seen clearly events over the past year, but we've also seen as we've worked to reduce emissions, with electric cars, for instance, you mentioned Musk. On the other hand, we've got Bitcoin mining that's actually negated all the gains we've made from that. So as you move forward as a regulator looking at the larger picture, what do you expect to hear from your companies? How do you expect companies to address the changing environment?
Yeah, I think it's we don't need reminding really how difficult the world is, and there's a sort of danger of that we swing from topic to topic, and actually climate change is treated as last year's priority, and now it's the war in Ukraine and cost of living crisis. So let's forget about that. And I think it's really important, particularly in an industry like insurance, which has such long-term horizons, that these differing and sometimes competing risks are managed in a sensible way. I think the coming back to some of the issues that we were talking about earlier, I think making sure that we are understanding what the risks are, what the sort of variance of under different scenarios might be, and then that we have that feedback loop to government and other interactions, so that the transition risk is actively managed. It's not a series of blind steps in the dark. That we are taking sort of conscious decisions about the speed of that transition risk, and that the cumulative impact of the industry and all of those individual commercial decisions is understood, and that intervention can be whether it's government or other forms of intervention can be managed in a conscious way.
Let me move to the industry side, Rakhi, and let me just add one thing here, if you could address it all at once. Liberty is a member of the Net Zero Insurance Alliance, which is, I think it's 20 of the world's biggest insurance companies, and they've committed to net zero at about 11% of the premiums. How does that, we've got the, I'm not sure if we should call it day-to-day changes, but, maybe more transient changes. But how does the Net Zero Alliance affect the way you do business in the long term?
Thank you so much. Just a clarification, we're actually not a member of the NZIA, but I think what I'm happy to talk about is the impact it is having on the industry and others, particularly on this side of the Atlantic. One of the things that NZIA, I think there's a growing recognition that making an NZIA commitment is the easier part, right? And it's also not enough. Now there is a question around what does it mean? Prove it by setting short-term, mid-term, and long-term goals. And that's where the challenge, that's what's really, really challenging. And let me explain a bit. And here I'm going to go back to the findings of our system-wide exercise that we did. What we found in the exercise and our system, or the models are telling us, is that for a company, the biggest risk facing the company or in those models are policy changes, right? And policy is driving behavior, market changes, etc. Technology is the area of opportunity, but again, there's no technology in the short-term horizon that's going to completely change the world and solve the problem, so to speak. So if policy is the biggest change, then we need to understand what is policy going to managing policy. And here we found that, and this goes back to the first question that was asked by the audience, we found that energy dependency of a country actually does influence policy design. So how energy dependent, how energy intensive, and how large your economy is will have an impact on how and the pathway, policy pathway that it's going to take. And another interesting observation is the world's not lockstep, working to the same time horizon. Europe is moving to a 2050 time horizon, China to a 2060 time horizon, India to a 2070 with caveats based on what Europe and China has done. So you're going to see very different policy behaviors and changes. And what does that mean for a company? That means it's divergent pathways, and we're not going to be able to have common, and again, comparability and commonality is the point I want to stress here. We shouldn't be trying to pursue common pathways, but coordinated action, which is in lockstep, public-private partnership again, with policy changes. Otherwise, you're going to land up with a situation, and just 2 days ago I read, there was somebody lamenting at the fact that, you know, the Exxons and the Chevrons and the oil and gas manufacturers who are actually far more efficient in the way they're getting oil out of the ground, right, are selling some of the assets to private companies that are not as efficient. So is that really helping the climate? So that's an example of where we really have to go deeper and try to understand some of these knock-on impacts and figure out how to, we don't have the answers for us.
It is an evolving topic, and we need to evolve as the information available to us grows. I'm going to turn to Amy, because I know we're getting very close to the end. We started a little late, so ignore that clock, it's wrong. Yeah, unless we want to go all the way through break. But Amy, you've got an interesting role in that you are a consumer advocate. You're there to represent the consumers, but you also have that deep knowledge of the insurance industry. So I'm going to go to this question, which is our top question now on Slido. And it says, does an insurance supervisor have a role with respect to fostering the transition to a green economy? What do you think of that from, not being a supervisor? What do you think we should be doing?
Well, I know that there's a lot of energy in being directed at helping insurers be an instrument of innovation and climate change adaptation. That insurers should reduce their investments in coal, for example, or that insurers should charge the risk-based price for a home that's being built in an area that's at risk, so that will send the price signal, right? So obviously there's a limit, to how much the private sector will do. So I think for regulators, I think you look at the programs, and again, I keep bringing it back to homeowners. A lot of this is just sort of magnified in the commercial and municipality context, but for properties, residential properties, look at what South Carolina has done with their Fortified program. Look at what My Safe Home, My Florida Safe Home. Look what we're doing in California now with the Safer from Wildfires. Those are all insurance regulatory agencies working with public safety partners, firefighters, and then the construction industry, realtors, IBHS, an incredibly important player, to build programs in these states through which we will be fostering and facilitating mitigation. So I think that's kind of, to me, that's something tangible that state regulators can continue to do.
Now, lightning round, because we're almost out of time. Everybody gets a minute. We've got a great audience here, some of the best minds in insurance, clearly very interested in where we go from here. If you want to leave, if you want somebody in the audience to have one takeaway, what would it be? And I'll start with you, Craig.
Climate change is, resolving climate change is a job for really all of us. And, not only in our roles as supervisors and consumer advocates and also as industry, but really our personal lives. And basically there is a saying that the problem is not to find an answer, the problem is to face the answer. And in us facing the answer, it's important that we amend our behavior so that we can transition the world to net zero.
Anna?
So for me, it's actually, it's about when we do these things. So I think we need to start making these changes that Craig is talking about now, and that we need to be making decisions. Now, we'll get better at it, we'll get more information, we'll understand better what the right mitigations, the most effective mitigations are, but we know some of these things now, and we need to start. 2050, 2070, they all sound like a long time away, but actually the decisions are here, and for the health of the industry, if not just the health of the planet, sort of shrinking, reducing coverage and shrinking the industry to sort of not provide the services that our communities need is clearly not the answer. So we need to be taking those decisions now.
I'd say having standards in place that are clear in terms of what is effective in reducing risk, and having those standards be a consensus so that we're all playing by the same rules is really important, and also recognizing that there's no they and them to blame, and just think about something you can do in the here and now that's concrete is much more productive than pointing fingers.
Rakhi, last word.
For me, it's tackling climate change is going to require us to be flexible and challenge our thinking constantly. There is no one size fits all. There is no right way. There is, just because someone's gone first doesn't mean it's the right way. And we should not let our desires to move or solve for a problem go beyond the realities in actual, like also look at scientific realities and what we can do today.
So don't let perfect be the enemy of good. Okay. Well, thank you all. Please join me in thanking our great panel here today. It was wonderful. And thank you all for being here. Unfortunately, we must subject you to a couple more minutes of the commissioner from Massachusetts, but then you'll have a break.
It's nice to see you too, Andy. Thank you to Commissioner Mais, in all seriousness, and to Amy, to Rakhi, Craig, and Anna. We really appreciate the thoughtful discussion.